Good afternoon, everyone. Thank you for joining us. This is Rob Woomer with Peachtree Hotel Group, and we are today going to give you an update on our various funds, recent performance, and the market. I'm joined today by Jatin Desai as well and Greg Friedman to answer your questions as we go. But before that, as advertised, we do have a very prominent guest speaker with us today, a guy named Dan Lesser, who is very well known in the industry. He's been around in consulting and valuation advisory services for a long term, is currently the president and CEO of his own firm, LWHA. We look to him as an industry for his knowledge and insight into values, what's going on in markets, and what the outlook is for markets. So we're very pleased to have him on the line today. And Dan, I'm going to turn it over to you and let you go ahead and pop your presentation up there, and then we can go from there. So we'll start with that, folks. Dan's going to show his presentation, and then from there, we'll go into the fund performance and answer any questions you have. So take it away, Dan.
Okay, thank you so much, Rob, for that kind introduction, and greetings to everybody from New York. Can you see my screen?
Yes.
Okay. All right, terrific. How do I go back? I want to go back. Bear with me one second.
Back arrow, or
okay.
There you go.
So the title of my presentation, I think, speaks volumes, and this really, has been, not just for the hotel industry, but for the world, a shocking, unprecedented event, at least, during the past 100 years. And I think it's safe to say that at this juncture, it appears that we've hit bottom. And I haven't heard anybody say it yet, but I remember in the early 90s, during a significant downturn at that point in time, the expression "stay alive till 95" was very prominent. So I've taken that and now calling it "stay alive until 2025." Although there are lots of prognosticators out there who believe that we're going to rebound sooner than 2015. So let's just take a quick minute to talk about hotels. I mean, I'm sure everybody already knows this, and it's fairly obvious. They're very, very unique forms of commercial real estate, right? They're not like office buildings and shopping centers and multifamily. They're operating businesses that have no credit tendencies, very compounded complexity in terms of the the ownership and capital stack, property manager, possibly a brand. There's so many players and involved in a hotel investment, and many times, we see deals structured where the interests are not necessarily aligned amongst all the parties. So that that causes even sort of higher risk for this asset class. It's also a highly leveraged, high fixed cost business. And then if you think about, today is a great example, the reliance on intermediaries, right? Hotels in Hawaii are just really like beyond crushed, right? How do you get to Hawaii but fly? So, reliance on intermediaries. The bottom line is the hotel industry is a very complex and it's a volatile business. So just taking a, sort of a quick minute, the world was obviously looking, really wonderful until early March, and in the hotel space, we had 10 years of rising room revenue metrics and records being set, 18, 19, and then the first 2 months of this year, new records set beyond that in terms of demand, occupancy, ADR, growth rates. And then profits were at all-time highs at the end of last year, and again, very, very beginning of this year, right? Then, unfortunately, coronavirus quickly spread to all 50 states. As of today, these are the current metrics. It's somewhat sad, but it's reality, unfortunately. So, going through this time period for myself since March, it's given me an opportunity to sort of reflect on my life. And you know, I can recall back as far as 1962, the Cuban Missile Crisis, watching black and white TV with you know, my parents, the news that ended at 11 o'clock, and you know, there were 6 channels of black and white, and after the news was on, the TV shut off for the night. So you know, at that point, there was a lot of worry in terms of the potential outbreak of nuclear war, and it was like, oh my God, the world's about to end. And as I look back on my life, I've gone through, you know, we've all gone through, depending on how old you are, you know, lots of calamities. Oh my God, the world's about to end, whether it be the Arab oil embargo, the 1987 stock market crash, when the market dropped, you know, 500 some odd points, which today is, you know, nothing, right? Then we had the first Gulf War, 9/11, the Iraqi War, and then the Great Recession of 2008. The point being that, you know, these are points in time where it appeared that the world was about to end, and it didn't. And invariably, the world, and the United States in particular, somehow ends up at higher peaks than prior ones. So, you know, been there, done that, and, you know, somewhat feel like we're doing it again. I like this chart a lot. It illustrates what the anticipation is of the investment cycle during this period of COVID, and we're still in the, you know, in the early stages of the game, right? The kicking the can, which is up in the upper right hand corner. You know, next phase is going to be, you know, come to Jesus later on this summer, you know, through end of Q3. You know, survive the winter, right? The winter is going to be very questionable, right? Is a second wave coming? We'll talk a little bit later about the sort of the current second wave, which I term as the second wave of the first wave. And then, you know, beyond Q1 of next year, God willing, you know, some sort of, you know, new normal. You know, the U.S. economy shrank very rapidly. You know, signaling the start of a recession. We can see here that the Wall Street houses are forecasting some, you know, massive declines this Q2, which just finished, but on the flip side, also a rapid rise in terms of GDP forecasts. The downturn was wide, deep, and swift. You know, these are some of the headlines from when the outbreak first occurred and was mushrooming out of control. You know, Marriott CEO Arne Sorensen, you know, coronavirus outbreak, in his opinion, was worse for business than 9/11 and 2008 financial crisis combined. You know, obviously, you know, extremely devastating, unprecedented, and a real challenge continues to be today. Demand was cut in half, and average daily rate, ADR, was cut by a third between March and May. Again, you know, deep and swift in terms of the declines in every metric. We had a run in the recent past for 11 weeks, starting mid-April, where occupancies were steadily increasing, and it was, you know, it was interesting. You know, the bottom in terms of decline in revenue per available room, or RevPAR, was, you know, negative 90% or close to it for 1 week, and you know, as time was going on, you know, it was really remarkable that, like, you know, negative 75 or negative 60 started looking appealing, right? Which is kind of mind-boggling, because, you know, pre-COVID, that would have been a horrific notion. So I guess everything's in relative in life. You know, the week of ending July 4th is when, you know, the beginning of this second wave was, the second wave of the first wave was starting to mushroom, and we've had a slight downtick since then. So clearly, you know, not out of the woods by any means. You know, again, you know, when we had declines in U.S. revenue per available room in 2001 and 2008 and 9, you know, those were perceived as very dramatic declines in and of themselves. Obviously, again, relatively, they look like blips on the screen to what's just recently occurred, which obviously can't emphasize enough how devastating it's been. There's been a big demand shift in terms of those hotels that have been hosting guests, and the economy segment of the industry has held up much better from a demand perspective than the luxury and upper upscale segments, and that sort of makes sense, right, given the price point. Let's just jump on here. So, top 25 markets, supply declines. 11 out of 25 top markets had over 20% of their rooms closed. And as you can see at the very bottom, Oahu had more than 50% of its rooms closed. Miami, was almost about 50 as well. So, just really stark numbers in terms of hotels that suddenly closed. And we talked about demand being cut in half, over the past couple of months. Again, just really unprecedented metrics. And somehow the hotel industry, they always manages to do this. We've hit an all-time peak in terms of new hotel construction in America in March of 2020. It's going to be a while before this pipeline, the great majority of which I think it's safe to say will ultimately get opened up. Some of it may never get opened up, but it's going to be a little bit of time before these new hotels get absorbed. Because if you think about it, all the closed hotels that reopen, they're going to be acting like new hotels in and of themselves. And so it's going to be a real struggle for a while. That's the bad news. The good news is that financing a new hotel to build these days is really next to impossible. So over the long term, the supply picture should look much better with absorption having occurred over a period of time. And again, these are just astonishing metrics. When you compare 2019 actuals, what looks like 2020's forecast, these dramatic declines. Revenue per available room is half in 2020 that it was in 2019. And I'm sure everybody knows this, but revenue per available room is the metric of occupancy times average rate. And according to Smith Travel Research, or STR is how they're known today, demand is not projected to recover to 2019 levels until 2013. 2023. So it'll be interesting to see, if that actually happens then, maybe even sooner. I mean, at the end of the day, I think it's safe to say that it's a game of confidence, and nobody has confidence right now. People don't have confidence to, fly, to stay in hotels, to ride trains, et cetera, et cetera. And short of a vaccine, it's going to be, I think, very difficult to get back to where we were, in 2019. With that, I do hope and do believe that a vaccine will bubble up. Some of the interim uses that hotels have been experiencing since the beginning of the pandemic, obviously housing medical workers and first responders, also housing homeless folks in cities like San Francisco, also serving as quarantine facilities. And then Citadel Securities actually took the Four Seasons in Palm Beach and set up a couple of trading floors and did their business from there for a while. I'm not sure if they're still in there. And then several hotels tried something different in terms of marketing to folks that were working at home with kids and dogs and pets and what have you, making lots of noise in the background and not being able to focus. And we're recruiting folks who within a short driving distance to come and rent rooms for the day and operate their offices out of these hotels. Liquidity instantly, when this became a thing mid-March, all the major public companies reestablished enhanced lines of credit. Obviously that was a very prudent thing to do. Cash has definitely been king for the past, couple of months here, and there've been some interesting initiatives, with Marriott selling gift cards at discount to raise money now. Marriott teaming up with Amex and Chase on getting upfront payments from Amex and Chase, for use of the cards. Same thing with Hilton. They sold $1 billion of loyalty points to American Express. So just very interesting how creativity was very quickly figured out on how to raise money. And clearly the sector has been braced for a rise in loan defaults and delinquencies. I mean, every day that goes by, we're hearing more and more about this topic. And I think it's fairly safe to say that the great majority of, I would say, CMBS loans, hotel loans in America, if they're not in financial default at this juncture, they probably are in technical default. And if they happen not to be in either one, it's either going to happen very soon, or there's a sponsor who's just feeding the beast. Litigation is clearly on the rise. Let's face it, there's always litigation out there, but we're seeing an enhanced amount of it, with broken up deals, right? The big one being Anbang and Murray in connection with the $5.8 billion strategic hotels portfolio. That's supposed to get litigated in I think the end of August, and it'll be very interesting to see where that ends up. In any event, again, we're seeing lots of in bad times, people fight less than in good times, and obviously we're not in some good times right now. And there's no shortage of investors that are out there that are ready, willing, and have already swept in and tried to take advantage of the situations. Blackstone and Starwood Capital picked up stakes in this Extended Stay America. The sale of the London Ritz I find intriguing. It sold for just about $1 billion, and what's interesting is that it's a 100-year hotel, and the day that the transaction closed, the property's operations closed for the first time in its history. So that was quite interesting. I'm sure everybody recalls that Airbnb had to go out in the market and pay for some very expensive money to stay alive. We're going to talk more about Airbnb in a couple of minutes, and then the Saudis took a big stake in Carnival Cruise Lines. So there's a lot of smart, sophisticated money from all around the globe that's focused on the lodging space and has already started executing deals. So, the $1 million question that bear with me one second, that everybody asked today is, and has been asking for, since mid-March, what's been the decline in value for hotels? I think, it's fairly well understood that, at best, maybe there's a hotel whose value has, stayed static. There can't be too many of those. There definitely, I can't imagine, are any hotels that whose value has increased since March 15th. So, early on there were pontifications of, 5 to 50% decline in value. I was quite amused at a lot of that chatter, because this is what I do. I live, I breathe. This is a hobby for me, the hotel business. I've been doing this for 40 years. And, a week, 2, 3 into this, I had no idea what the value decline was. So I was kind of perplexed, like, how did some of these prognosticators know? I mean, the reality is they didn't know, right? Nobody knows. Nobody still knows today. But as time is going on, we're starting to see some market-derived metrics, and I'm going to get into that in a little bit, to indicate some semblance of what the decrease is. I was on a call with a couple of CFOs from 2 publicly traded companies and 1 privately held company, and they said, it was very interesting. They said, if you think about the notion of market value and the definition of it, which is up here on the screen, willing buyer, willing seller, neither acting under duress, right? For the past couple of months, there have been hang on 1 second. I'm sorry. Just let me get rid of these phones. Sorry about that. So nobody in their right mind would put a hotel on the market today unless they had to, right? And if they had to, then it's liquidation value, and liquidation value is for sale and more than likely an all-cash deal. So it is kind of interesting, that there really are no willing buyers, no willing sellers out there unless they have to. So these CFOs were saying that if you think about it, there's no market. So theoretically, is there no value? Well, of course, that's ridiculous. There's value, right? But in the hotel business, you really need to look long term, to figure out, what value is. Awaiting price discovery. We talked about that, and again, there's going to be a couple of metrics here, but these are a couple of smart guys at Origin Investments. They don't invest in hotels, but they're a hedge fund who came out and told their investors early on in March that they really had no idea what was going on, and that's a phenomenon that, in my humble opinion, was the case up until not that long ago. So in the second quarter of this year, there were 4 announced major sales of hotels in the United States, and I emphasize announced. The Union Station Hotel in Nashville that Pebblebrook announced a sale of, they hope to close it in the 3rd quarter. My understanding is that the contract is not hard, so that's obviously an announced deal. The other 3 are transactions that have closed, and defining major is $10 million or more, and not being part of a portfolio. So you had a Courtyard in Boynton Beach that sold for like $19 million, a Quality Inn in Kissimmee that sold for a little bit over $10 million, and then the Hutton Hotel in Nashville. So there have been a couple of trades, but what's very interesting is that if you look at the 5 sales that occurred in Q2 of this year, they totaled $235 million. Compare that with Q2 of 2019, there were 35 sales in that quarter for a total of $2.6 billion. So in terms of dollar volume, this year of Q2 compared to last year Q2, 90% lower in dollar volume and over 90% lower in number of trades. And again, if you look back at 2018 Q2, there were 44 trades for a total of $3.5 billion. Again, compare and contrast that to the 5 that sold in Q2 of this year for $235 million. The transaction market, for all intents and purposes, is frozen, and a good part of that has to do with the fact that there's not a whole lot of debt out there. So this is the big metric that everybody's looking at. This deal just closed recently. Sunstone having sold the Renaissance Hotel in downtown Baltimore, and the word is that the original price that had been negotiated was $100 million. In February, it closed at $80 million, so that implies a 20% discount. But the reality is that it's more of a discount, because the revised transaction not only embedded a lower sale price, but it also required the buyer to come up with a significant interest reserve of over $6 million, and then an operating shortfall reserve of $2 million. So if you think about that, you're showing up at the closing table in addition to the down payment with another $8 million of cash. So that WACC, if you will, of 20% is actually higher than that. So that's a recent trade, and that sort of fits into the 5 to 50%, that we talked about earlier, that folks were pontificating about. Looking at another trade, going back to right after 9/11. This is a deal that I actually worked on pre 9/11 and then post 9/11, when Security Capital sold the Homestead Studio Village Suites to Blackstone. The deal was originally supposed to go down at 900 million, and it ultimately went down at 740 million. The deal was originally negotiated in August, and it closed in November and December, and that worked out to just shy of a 20% decline as well. So sort of interesting. We're hearing 20% again. By no means can you go out and slap a 20% discount on all hotels across America, but it does provide some guidance. I think it's safe to say that there are some that may be as low as a 5% decline, and others that may be as high as 50% decline or even higher. Right? If you think about hotels in New York City, or frankly other parts of the country that were already at the edge of a cliff in terms of struggling, again, particularly New York City. All COVID did was sort of advance that phenomenon and was the final death knell. But these deals ultimately were getting into trouble to begin with. Ethan Penner, who's a friend of mine, and I'm actually on his board, he really is the father of CMBS, and he came out shortly after the pandemic broke out, and was musing a tad that CMBS, when he invented it in the early to mid 90s, was a model that was built for the times back then, and it worked well, but it was not a model that was built for a 20 some odd year duration. And so I think we're seeing today the result of what he's talking about in terms of it's so difficult to deal in a CMBS structure with anybody. There's nobody to talk to, right? And all these deals are in if they're not in special servicing, they're almost there. And the special services are absolutely inundated and don't have enough personnel to handle all the incoming issues vis-a-vis CMBS. So I think when CMBS, if it does come back, it's gonna look quite different. So where are we now? Sponsors and managers have clearly been in very defensive positioning, particularly those that own lots of real estate. The lodging debt markets I alluded to earlier are generally paused. There's no liquidity in the commercial mortgage bond market for hotels, and existing lenders are generally on the balance sheet side, everybody's trying to play nicely in the sandbox and giving 60 to 90 day interest forbearance, obviously accrued, not forgiven. Everybody's trying to play nicely. I do believe that come Labor Day, the sharp elbows are going to come out, and that's where we're going to see a fair amount of movement in the market, whether it be note sales and or foreclosures. And then earlier, I said that the private markets are just flush with tremendous amounts of capital, waiting to go on offense. And I think it's quite interesting. I do believe that given the significant amounts of capital that are out in the world chasing yield, that we are going to see distressed opportunities and distressed transactions occur. But I believe the prime opportunities that the institutional capital is going to be chasing, there's so much of it, it's going to end up getting bid up to the point that they may be distressed transactions, but they will not necessarily reflect distressed pricing. In terms of where we are, the hotel brands have been very, again, playing nicely in the sandbox, and very flexible in terms of offering significant fee relief for franchised hotels. We talked about lenders. That's on the right side. Attempting to show some short-term flexibility. The road ahead, It's obviously going to be, a bumpy one, but the 11-week run of increasing occupancy that ended week ending July 4th were, clearly perceived as green shoots. And, hopefully, maybe just one or two of those shoots got burned by the sun, but will continue to endure as we go on here. Yogi Berra was famous for saying it ain't over till it's over. And, unfortunately, we are seeing that, there was a glimmer of hope there, when the Northeast was on the rebound in terms of recovering from the spread of COVID, and the Southeast and the South and California had not exploded yet. And there was a glimmer of light. And now, we're seeing, again, what I term as the second wave of the first wave, right? So if you think about it, the notion of when is the hotel industry going to get back to quote unquote normal? Well, you tell me when the economy is going to get back to normal, right? And the economy is probably not going to get back to any semblance of normalcy, until this virus is behind us. In many ways, we've seen, we've seen this movie script before, in terms of the rebound and what it's going to look like. Leisure drive-to traffic is going to be the first to rebound, and we're already seeing that, albeit at very reduced room rates. The hope is that then corporate travel is going to follow, and group meeting and convention, which is in all likelihood going to be quite a ways off before folks are attending large group meetings and conventions in Las Vegas. No shortage of challenges that exist out there. The economy is sending mixed signals as to how long this is going to, the down market's going to continue. The airlines are obviously in terrible shape, and frankly are way behind recovery, particularly when compared to the hotel industry. And the Delta actually came out and said that we may never see as many business travelers as we did before, right? Are folks getting comfortable with these types of meetings? Probably to some degree. I don't believe it's going to be a major component of business going forward, once there is a vaccine or a cure or whatever. But let's face it, more people will probably be end up working remotely than did pre-COVID. So clearly, challenges there. As I said, no shortage of challenges whatsoever. The bottom one, Jonathan Litt, who's a very smart, sophisticated investor, is shorting New York City office stocks, which is quite interesting. He's a real bear on downtown urban core office markets. That's not a good thing for the lodging industry, right? The relief packages that we've seen come down the pike has actually made being out on unemployment more economically compelling than going back to work, right? So these are real tough issues to deal with, right? You're ready to open up, you can't open up, and then you can't get people to work. That's tough. And then even more challenges. The word is from the American Hotel and Lodging Association, unless there's some government assistance coming down the pike here before September, they estimate that 8,000 hotels in America are going to shut down. And, we already know that, like in New York, Broadway will not reopen before January. And there's even a question of whether that's going to happen, right? The New York Marathon has already been canceled. That usually occurs in November. And then, consumers are planning on spending money as openings reoccur, but they've already opined that they're going to be more cautious with their spend dollars and not spending as much as they did previously, right? And then, finally, huge challenge is recurrence, second wave of the first wave, and or a second wave. Right, Las Vegas, and we've seen this other parts of the country that may have opened up too soon, and people just gathering together as if nothing's going on, and then 2-3 weeks after that we see a rapid resurgence. never let a crisis go to waste. And so the hotel industry, has made a big deal about cleanliness, and everybody's come out with their own programs. But the fact remains, and I guess what I find interesting is that I've heard a lot of folks in the sector, senior C-suite folks, say, well, the hotel industry has always been squeaky clean to begin with. Now we're going to be that much cleaner. And I find that a little bit disturbing, because the reality is, if you just do a Google search on disgusting hotel, I mean, you can see all of these headlines, with the exception of the one lower left-hand corner, are from years ago, and report about some of the frankly horrific conditions in even luxury hotels in America. The scary thing is this headline on the lower left-hand corner, June 29th, from Inside Edition, that an investigation showed that sheets in New York hotel rooms, bed sheets, were not being changed between guests. I mean, it's absolutely mind-boggling if that, in fact, is true. But cleanliness has been and continues to be. Sanitation has been an issue, if you think about it, not just for the lodging industry, but for all forms of travel, right? The airlines, trains, what have you. And it's going to take a while to figure this out. And again, it's a confidence game, getting people confident. So, the new normal, the U.S. travel industry released guidance for travel in the new normal and what that all means. I mentioned a minute ago about the American Hotel and Lodging Association coming up with a Stay Safe program. It was great what they did. They assembled on an advisory council, really the who's who of brand companies and some major investors and owners, and came up with a cleaning protocol. But then each hotel company came out with their own sort of spin on it, right? And Hilton aligned with Lysol, and Four Seasons aligned with Johns Hopkins, and I'm unfortunate that that the industry didn't stay in unison with the AHLA's guidelines, and I don't understand why each one had to go out and now try to. I mean, so basically, what you're selling is, I'm cleaner than the next guy. I don't know. I think that's really a wasted effort, and I hope it doesn't last too long, quite frankly. Some of the travel paradigms that are going on, in addition to no shaking hands, obviously wearing face coverings while traveling, temperature checks, airlines holding down middle seats and not booking them. We'll see how long that's going to last. I understand American Airlines has gone back to, fully booking, their flights. Probably has to do with the economic condition they're in. Some of the paradigms that we're going to see in the lodging industry, facial recognition, contactless. Everything's going to be contactless now. Key entries, via mobile phone. It's interesting that technology has been around for a long time, and it was reserved for frequent travelers only, of hotel programs. Now it's going to be standard for everybody. Hilton came out with the seal on the door. I do find that somewhat interesting, because I don't know what that exactly tells you. Okay, so it says that nobody was in the room after, theoretically, the housekeeper was in the room. You still have to hope that the housekeeper did the right job. Food and beverage, we're going to see, lots more grab and go, and less, less sit down type dining. The use of robots, which again has been around for quite some time, but we're now starting to see, getting implemented in terms of delivering, whether it be food in restaurants, or items to guest rooms. Casinos have actually, during the past couple of weeks here, the ones that have opened up, have a great majority of them have prohibited smoking because of the pandemic. It'll be interesting to see whether, because if you think about it, casinos are probably like the last place where you can smoke indoors quite freely. It'll be interesting to see whether these policies stick or not going forward. We talked about the abundant availability of capital out there, and really smart folks, whether it be Barry Sternlicht or the Blackstone folks or Thayer Ventures, and not just in the hotel space, but just commercial real estate, right? Barbara Corcoran, Shark Tank, Corcoran Real Estate. For somebody like me, it's the perfect time to buy. She's smart and sophisticated. So, I think it says a lot. And again, there's so much a dry powder institutional money out there, looking to take advantage of the situation. The future, clearly the world is being very challenged on many fronts. As I said earlier, hotels that were already, over levered or had stressed cash flows, weren't going to make it, and this was just a push forward, and they can't be resurrected by short-term interest payment forbearances. Capital stacks will clearly are being restructured. Money that's going to enter the space is first going to go to assets that are well located and are associated with high quality sponsors. There's probably going to be a significant growth for soft hotel brands, because independent hotels, where there's nothing wrong with them whatsoever, there is a challenge convincing the traveling public that there is standardized cleanliness in independent hotels like there will be in branded hotels. So that'll be an interesting phenomenon to watch. And speaking of brands, brand proliferation will be placed on pause, I should say, and hopefully for a long time, because God knows the world has more than enough hotel brands. A couple other things, supply growth will lag, in addition to whatever is in the pipeline being absorbed. We talked about construction financing not being available, but then there are also a whole slew of hotels that have closed that will not reopen as hotels. We talked about leisure travel, rebounding first, then business, and then group meeting and convention business, which is going to take quite some time. And convention center and large group meeting hotels, 1,000+ room hotels, are going to be challenged for many years coming, unfortunately. Low inflation is anticipated to continue to endure, so that's favorable on the cost side. There's no shortage of energy out there, so no pressure vis-a-vis utility costs. I think it's safe to say that every hotel in America is appealing their property taxes. That's an interesting phenomenon, because municipalities are for the most part broke. So maybe you'll appeal your tax assessment and everybody will get a reduction in their assessment, but municipalities still need to cover their budgets. So all they're going to have to do is just raise their tax rates to match the reduced assessments to still raise the same and probably more money to operate. So sort of good news and bad news. Acceleration of incurable functional obsolescence will result in many hotels never reopening. Again, probably a classic example would be the Hotel Pennsylvania by Penn Station in Manhattan. And in 2006, that hotel, Vornado, was going to close it, tear it down, and build Merrill Lynch's world headquarters on that site. Deal fell apart, then the world fell apart, and it never happened. And so they ended up running the Pennsylvania, as a hotel until it recently closed due to the pandemic. There's a good likelihood that hotel will not reopen and either be converted to an alternative use or torn down and something else built in its place. And actually, this next slide, near term, shows us about not only the Pennsylvania hotel, but the Marriott Wardman Park. It's more than 100 years old in Washington, D.C. This talk about that significant large hotel also closing. It is functionally obsolete, and its obsolescence that is incurable. No matter how much you spend, it can't be cured unless you tear the thing down. Jingle mail, that's a term that was commonly used last couple of downturns, which essentially is a sponsor deciding that they're done with an asset and they're not going to invest any more in it, and putting the keys in the mail and mailing it to a lender. We're going to see a fair amount of that coming down the pike here in the not too distant future. Also, in the near term, Yeah, we talked about tax appeals. We also talked about the cost that to cities of not only hotels that are appealing their taxes, but hotels that have been closed and are not collecting room tax revenues, right? I mean, the hotel's been closed, so there's no revenue coming in on that side. So lots of challenges. There's also a lot of money out there that's being earmarked as rescue capital, that's trying to to get ahead of opportunistic buyers, right? That are looking to just take over assets day one. Rescue capital. I mean, I hear lots of folks say, oh, we're friendly, right? We're not looking to be difficult to work with. We want to help people, which sure, that sounds great, but at the end of the day, it's all about making money, right? So it'll be interesting to see how some of this rescue capital is deployed, and ultimately what happens. Is it loan to own type of money, or is it truly capital that is risky but merely looking for a return, and not necessarily looking to take over an asset. U.S. metro areas that are the best and worst positioned for pandemic recovery. Those that are have low population densities and high levels of education, which are the upper left-hand corner, are in much better shape than communities in the lower right-hand corner, a la Chicago, Los Angeles, and Miami, which obviously are very dense metropolitan areas. Airbnb, we could talk a whole day about Airbnb, but the bottom line is that their wings have clearly been cut, right? Their valuation was cut in half. If you factor in the the valuation that was used for the 2 rounds of billion-dollar financings that they took down. I think the fat lady has a song, and it's going to be a real challenge for Airbnb to get travelers comfortable with the sanitization issue. And so, I think it's going to be very interesting to watch. I've actually thrown out a gut feeling. This is based on nothing but merely gut feeling. If it happens, remember you heard it here first. If it doesn't happen, forget I ever said it. But I think Airbnb might be ripe for a large hotel company, multi-brand hotel company, whether it be Hilton, Marriott. It might make sense for Airbnb to sort of merge up with a hotel brand family. Again, I'm not starting rumors. It's just a gut feeling that I wouldn't be surprised if it happens. So listen, in life, you can look at the glass half full or half empty. Here are a couple of headlines from folks that are looking at the glass half empty. What's interesting is Sam Zell's a comment in the upper right-hand corner, because that was on May 5th, 2020. And then if you look at the glass, half full, he was recently quoted as saying that the U-shaped recovery is not that far off. So, it is interesting. These headlines are all from the same time period, whether it be, May, June, and July. And they're very contradictory, right? This is very positive in nature, and this is somewhat negative in nature. I think what it shows is that, as we keep saying over and over, nobody really, really knows. So just wrapping up here, I came across this article that I found quite inspirational. And this gentleman, Tony Vaccaro's mother, died in childbirth, and he was an orphan at a very young age, and grew up with a very troubled childhood. And he recently turned 97 years old, and he's getting over a bout with COVID at 97 years old, right? And having gone through such a difficult life. And so that was just, I don't know, I found that very inspirational, and that what gets him through is grit and red wine, right? We can all relate to that. And then this one's also very inspiring, right? The 107-year-old woman who survived the 1918 Spanish flu and also survived COVID-19 all in one lifetime. I mean, that's remarkable when you think about it. And I think it's the type of thing that, gives me hope and hopefully gives, everybody else hope here. And so with that, I'd like to just finish up with this saying that I like: in all things, it is better to hope than to despair. So with that, I thank everybody very much, and I hope I did not go too far over my time limit.
Hey, Dan, we really appreciate you coming on today, and definitely love your insights, so very much appreciate it. We do have a couple of questions, but in the interest of time, so we went over just a little, but not too much, Dan. I'm gonna table those, and I'll get back to those folks that were asking those questions. But we really appreciate it, and again, love to have your insights on things. So thank you very much from all of us at Peachtree Hotel Group.
Thank you very much.